a sunny Friday. Behind us is you see our South Beach, Miami. We're in the Midtown Miami. With me we have Sam, Castelan, and George Kroustalis.
Thank you, Nelly, the beautiful Nelly Kiffa, with us today here in Midtown Miami. As she said, South Beach, we can see you. We can see you. It's a sunny Friday. It's a feel-good financial Friday. Sam, thank you for hosting us here on the wonderful, beautiful, sandy set we have here.
George, I'm honestly very happy to finally do this in person with you. You're a last celebrity, and Miami wanted to see you in person, so thank you for coming with us.
Right. Thank you. Thank you.
So, George, we have a lot to talk. You know, like we have done our Feel Good Financial Friday for now, like 8 weeks, and so I thought it was a good point to really, get to know you better and get a closer look on all these aspects that are coming in the economy right now. It's like we have had all these crazy weeks in the market. I'm still wondering if we're in a recession or not. So take us from there. Tell us where we are in the economy and the financial market sector right now, and where are we going, George?
It's a question on every investor's mind and every one of ours mind. The market is voting literally every day. Earlier this week, we got a hot CPI number. That's the Consumer Price Index. Hit 9.1% year over year. And what that means to our viewers out there who are joining us for the first time is the fact that prices on average are up 9% from last year. Now, if you're putting gasoline in your car, or if you are putting food on the table, which all of us eat at some point, it costs a lot more than 9% than it did last year. Prices are up a lot more than 20% in some cases, especially the rents down here in Miami. But that number came in hotter than expected on Wednesday, which means higher than expected. Market didn't like that. Thursday, same thing, market didn't like that. So what that's done is created down for stocks or risk assets. On the flip side, today we get a retail number this morning, which means the U.S. consumer has not stopped spending money, which was seen as a positive, meaning we're not going into recession. Dow's up over 500 points and the market's up big based on that number. So it's a voting machine. The market is voting very short term. It's very volatile. For the long-term investor, volatility can be your friend. If you have money to consistently average in, we call that exercise dollar cost averaging. And it's a great thing for stocks.
Well, let me ask something. Like, for instance, on that number, remind me the name of that metric where, the consumer, basically, we're seeing the consumers keep that consumption up and up and up. Like, isn't that bad for the inflation now that we're trying to push back on that inflation?
Yeah, so it's both. It's live by the sword, die by the sword, right?
Yeah.
So one thing the Fed is trying to do, that's a great segue, by the way, Sam. One thing the Fed is trying to do, the Federal Reserve Bank, they're hiking or raising short-term interest rates. And what that does is eventually, when the cost of money, as it keeps going up, it will kill demand. Basically, they're almost self-fulfilling prophecy of us falling into a recession. Because if you kill demand enough, there's no mortgage activity. We talked about that earlier, and on many of our last few Fridays telecast, the fact that housing is slowing down right in front of us. As a matter of fact, June, the numbers came out earlier this week. In June, last month, 15% of all contracts didn't go through. Either the seller walked or the buyer could not go through with them based on interest rates alone. So we're seeing that have the effect, the desired effect of what the Federal Reserve wants, which is to slow down inflation, slow down prices going up, and how you do that is you basically throw the economy into recession.
And see, here's the fact that I see, right? Like, people keep complaining about government and how they're creating inflation, but what I see really is that inflation was created by the Fed, of course, and this was created by back in the day, 2 years ago, we were with COVID, right? But the Federal Reserve was trying to print all this money, trillions and trillions, and you probably know that number, to try to rescue the economy back then, to keep jobs coming, just jobs coming up and etc. just to save the economy. But at the same time, that's probably way too much, right? Way too much money. And what I understand, 40% of every single dollar that was created was in the last 2 years, right? Something crazy like that.
That is correct. That is correct. So in hindsight, all these things, we can all play Monday morning quarterback, right? I mean, all these things are now evident. The Fed and the government threw in, increased money supply by 40%, virtually within, 3 months. And when you do that, it creates just a flood of free money, and it's got to find a home. And of course, the smart money wants to find the highest return. So it was an incredible time for risk assets. And I'm not just talking about the stock market. Take a look at crypto. I mean, Bitcoin after COVID fell to, the 5,000, I think, dollar mark, $5,000 to $9,000. And as recent as last year, in the highs, got as high as $65,000. Think about that. That's over 5 times. So it's been an amazing run for all risk assets. Stocks weren't left behind, so everything made money. And now you have seen, virtually since the beginning of the year for the stock market for tech stocks, it started November of last year, of 21, you've just seen long duration assets sell off.
I'm talking about inflation. We have a surprise for all our guests out there. So we wanted to invite today our beautiful Nelly Kiefer all the way from Germany. And so you guys know that in Germany really actually is one of those countries, right, in Europe where they have like negative inflation. So I wanted to explain to us what is like negative inflation, what is like negative interest rates, excuse me. And then maybe we can ask Nelly how she feels like the comparison in terms of prices from Europe to here.
So your negative interest rate
thank you,
was accurate. The German Bund is now yielding positive. German rates, along with many European rates and Asian rates, were negative yielding rates for years. In the case of Switzerland, it's been like that for nearly a decade. These are all now turned positive because of inflation. So they're making some money on their money, I guess, eventually. But another interesting thing about Germany, it has always been an export-heavy economy. Think about it, with beautiful automobiles, BMWs, Mercedes,
oh my God,
Porsche, now owned by Volkswagen Audi, but always an export economy. They are now importing more. Part of that is because of what's happened to the energy market, hence the chaos overseas and the calamities in Ukraine. So energy looks very different. But all that being said, another byproduct, which hopefully, Nelly, you exchanged your euros for dollars a long time ago, a few months ago, because this year alone in 2022, the euro has lost about 12.5% against the US dollar. What that means for people with euros, they can now buy fewer dollars. For people with dollars that are going to Europe, you can now buy more euros. You can make that vacation, you can upgrade, you can have that, yes, you can order another bottle of Voo if you want, or Moet, if that's your preference, but yes, you can have another drink.
So Nelly, how do you feel the economy in Germany or Europe in general compared to the US? Like, what are the effects, or like like when you compare both, like how do you see jobs there, like the economy and everything?
I mean, in Germany, also one thing, it's really easy to find a job here. In Germany, you have to go through a lot of paperwork and things. You have to be insured, you have to be secured. You need an insurance for every kind of job you do, also when it's just 4 hours a day. Yeah. When I try to live healthy in the US, you have to be rich. So really, also the vegetables and anything. In Germany, it's so cheap. Anyone can live healthy. But in the US, it's more worse. So it's, for me, better to go to McDonald's or something instead of buying my own vegetables and cook for myself.
Yeah.
Yeah, I mean, here you've got, Whole Foods right down the street here on Biscayne. It's busy, but like you said, it costs a lot. It costs more to buy vegetables than it does meat.
Yeah.
At a lot of times.
Yeah.
Especially chicken.
Yeah.
But yes, it is more. And with my background and traveling to Greece most every summer, I can tell you that eating healthy there is very simple and a lot less costly than it is here in the States.
And it's interesting to discuss what we were saying about like the interest rates, because you know what that effectively means is like you have money in the bank, and then suddenly your money is less and less worth it, right? Because the interest rate is negative, or were negative in Germany. And so I wonder now that that we're seeing a downturn in the economy in the U.S., how like do you think that we get to a point where like we will go to negative interest rates, or now we're back?
It's the opposite. It's the opposite. Yeah, 3-month T-bill, which is a measure of the shortest duration, if you will, 3 months, 90 days, is over 2%. That doesn't sound like much, but that yield was 0.03 when the year started. That was only 7 months ago, and now we're over 2%. So, you know, rates have risen, short-term rates. That's because the Fed is raising short-term rates, so naturally that will rise. So negative yields are a different dynamic than what the interest rate is when it comes to saving, etc.
So George, I just want to thank you for your time right now. This is our first segment, but we're gonna come short after this little commercial. So thank you for your time today, George.
You're welcome.
I'm in my 20s, so how do I invest?
Yeah, George, like how do we pick stocks?
Quite simple. Invest in what you know. Corona, Constellation brands, Napkin, Procter & Gamble, Apple, iPhone. There's your 3 stocks right there.
All right, cheers on that then.
Cheers.
My Robinhood stock portfolio keeps going down, George. Like, what should I do?
Dollar cost averaging, systematic purchase of additional shares every month at ever lower prices. And that is how you can make a lot of money. So in other words, keep calm and keep on investing.
Cheers to that, George.
George, should I care about dividends?
No, that's a great question. The answer is yes. Companies that pay dividends typically have a long record of stability and consistency. And actually, the company who produces these Bounty paper towels, yes, the quicker picker-upper, is Procter & Gamble, and they are one of the best. So yes, dividends matter.
And we are back. So thank you guys for continuing with us. And George, you know, like just to wrap up, we have like a few minutes left, but I just wanted to ask you, like, in these times of uncertainty, on like the market's down and everything, can you just give us like some words of encouragement on where to go and what to do?
Thank you, Sam. Always great to be here. And you know, it's Friday afternoon. The words of encouragement may be to go over the bridge to South Beach and have a cold Corona. But no, you know, listen, I get the question a dozen times a day, and the best advice for long-term investors, you take advantage of the volatility. And what that means, the exercise well-known in investing called dollar cost averaging, systematically buying every month. No one knows when the bottom's going to be here. It's unknowable. So you continually buy in things that you believe in, whether it's a company, whether it's an index fund, or an active mutual fund. You continue to add dollars to it, because eventually buying low is how you make a lot of money in the long run.
And especially thank you, Nelly, for being with us today.
Oh, I have to thank you too, really. This was so glad to meet you guys. Thanks for Sam, and thanks to meet you, George. So thank you to be a part from your Feel Good Financial Friday.
Yay! You're welcome to come back from Germany anytime and join us on our set here on the beach, Midtown Miami. Thank you, everyone out there, all of our viewers. Have yourself a wonderful Friday and a wonderful weekend. Adios.